at 10. So
cool.
Where are you from? Cool. Where are you living now? Where are you now? Are you in New York?
I live in Puerto Rico, the southern side of the island.
Oh, wow. So you're smart.
Del Mar.
Yeah, John Malden moved there, right? You get to escape all the...
he lives up on the north side.
Yeah, so you're smart. Okay, we're starting. We're live now on YouTube. I'm Josh Jelinski, the financial quarterback. We are going live with CNBC's John Najarian of Market Rebellion. This is exciting. So we're live on Clubhouse right now, YouTube, and WOR every Saturday and Sunday at 9. So ping in your friends. So first, John Najarian, professional investor, market analyst, publisher of market observations and trade ideas on Investitute.com. You've maybe seen
Market Rebellion.
Market Rebellion. I don't know why somebody gave me the other thing.
Well, it used to be Investitute.
Yeah, Market Rebellion's cooler than Investitute.
Yeah, we just thought the name was cooler. And so I think, Josh, a couple years, maybe 3 years ago, we changed it to that. And it has stuck. So it's a pleasure to be with you, Josh. Thank you.
Great. And for those who are not familiar with your work, describe your background and what got you into money.
Well, I've always been interested in money. What got me into trading was I was playing football for the Chicago Bears. I was an undrafted free agent. So not a quarterback, but a linebacker, Josh. And so I got to play with Walter Payton, Mike Singletary, who my mom said kept me out of the Hall of Fame. And it was great being with the Chicago Bears, obviously, even though the team was not winning. So, pretty much terrible football team at that time. But they had so many great pieces that they'd put in place. And then they got the final few the year after I left. They got a new coach, Mike Ditka. They got McMahon as quarterback. They got Willie Gault at wide receiver. They got Steve McMichael to help out Dan Hampton on the D line, and boy, just Wilbur Marshall. So many guys that just between my year and that next year, Josh, they just became a world beater. And obviously they won the '85 Super Bowl. I don't think anybody has had as few points scored against them as the Bears. And they were a very fun team. And I was sad to not make that team. I only played 4 games, but that's what brought me to Chicago. And so I'm grateful for that ever since. I love Chicago. I lived there for almost 40 years. So it's a great city and love the exchanges and all the men and women I've worked with there. It was really a kick.
That's fun. So you were the forerunner. Did you play with Refrigerator Perry, or he was after you?
Yep, he came that next year as well. I mean, the guys that were drafted my year or were free agents, like, for instance, Hilgenberg was our center, and he was a free agent out of Iowa. He became an all-pro, multi-year all-pro, and started in the Super Bowls and all that stuff. He was great. But the drafted guys were like Todd Bell, from Ohio State. He broke most of Jesse Owens' records at Ohio State, to give you an idea of how good an athlete he was.
Wow.
Defensive back, built like a linebacker. Leslie Frazier, who coached in the NFL along with Singletary, of course. He was a head coach, I believe, for the Vikings for a while, and a great defensive back. Let's see, Keith Van Horn, multi-year all-pro offensive tackle. So we had a pretty star-studded cast. They really, if you get a good draft and then you develop those players instead of losing them, you could set yourself up pretty well. But sadly, the Bears, after the Super Bowl, started either trading away or not paying players as much as the players thought they were worth. And I was gone at that point, of course, but that's why we lost Wilbur Marshall to the Redskins. And we lost so many great players, and you can't go from a Super Bowl champ, nobody can beat you, to and also ran faster than losing a bunch of your quality players. And sadly, that's what the Bears did.
Yeah, that's quite a reversal. That's one of these teams that could have been a dynasty. They could have been like the Cowboys. People forget how good they were. I knew how good they were because I'm a Detroit Lions fan. So I'm a long-suffering. I do think their new coach, he reminds me of like Ditka in '85. So I think eventually they'll be good. Give me some hope.
I think so. I mean, they had Megatron. They obviously had the Super Bowl winning quarterback, but they couldn't win for him. Matthew Stafford, they couldn't win for that guy. And he was always good. I mean, everybody in the league knew he was great, but they just didn't have the tools around him. And all of a sudden, you put a couple all-pro receivers out there and, things turned out much better for the Rams with Matthew Stafford than they ever did, sadly, for your Lions.
No, I knew how good he was. I didn't understand why they didn't trade. I still think that trade was a bad trade. But
yeah,
I think they should have got more picks or something. Although we'll see, right? I mean, I guess this year was the fruit of that trade, but we shall see. I think people thought he was one of these like Donovan McNabb, like a good quarterback, but not great. But I would see him every week with no offensive line, throw for 400 yards. I mean, they didn't really have a cast of any characters. They had no offensive line, no defense. So it may be good to rebuild. And I like the new draft picks as long as they stay healthy.
They got a lot of great ones this year.
So football prepared you to be a floor trader. What was your greatest lesson as a floor trader for 25 years?
It was never lose big. Too many people on the floor or off the floor, if they blow themselves up, you know this, Josh, but they do it because they rode a loser too far. Doesn't matter if it's long or short. If you're on the wrong side for too long, you can lose, all your money and probably destroy your confidence in yourself. So I was a guy that went into it knowing that occasionally you're going to hit a home run. But it's going to be like Babe Ruth's day when, as you might recall, Babe was a home run hitter, but that was kind of frowned upon back then. They were all about, just very limited home runs and a lot of base hits, almost like Moneyball. And I was definitely a guy that embraced that, much more of a Moneyball. Let me get on base. On base percentage is everything. And the more you're out there, getting on base and getting, making money on as many trades as possible, rather than betting it all or betting a lot on a trade that doesn't work out. There used to be an ATM in the Board of Trade that I'd bring all of our young traders down to, Josh. And I'd say, okay, before you're going on the floor with our money, I want you to watch this. And I'd put in my debit card and I'd ask for $200 or $400. And this particular machine, for whatever reason, only spit out $5 bills. So, it would just go, and it's just spitting out the bills, not all in one chunk like they do today. Instead, you could hear them dropping, tick, 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 tick. And all of a sudden you got a stack of bills. And I'd say to the guys, okay, those are all teenies, meaning 16ths of a dollar, because 16th is $6.25. So this is the closest you could get to it, really. And I'd say, that's what I want you to do all day. Grind out teenies. If you grind out teenies hundreds of times, thousands of times a day, you're going to be a happy guy. You're going to make a lot of money for a long time. If you always want to bet on a home run, you're either going to be, Mark McGuire, Sammy Sosa, whatever, or you're going to be some of the other millions of players that can't hit home runs regularly, and instead they strike out a hell of a lot. And in finance, that means you're not going to have a long career.
Oh, that's great. And your book, Follow the Smart Money, is that your latest book?
Yes, it is. Yeah, my brother Pete and I wrote that one, Josh.
So, folks, get the book, follow the smart money. Anything else you want to promote before we go to the break, first break of the hour?
Just check out Market Rebellion. We've got a lot of cool stuff there, marketrebellion.com. And we got to get you down at one of our conferences probably, Josh. We're doing one in September in Dallas. I'll reach out to you after the show and see what your appetite is for that. But we have these great shows where we bring in people like Kevin O'Leary or Mark Cuban and a bunch of these folks for like a 3 or 4 day conference on trading. And it's really pretty cool. The next one's in September, 21st through 24th. And they'll find it if they go to marketrebellion.com /Dallas.
I hung out with Cuban one night at Scaramucci's. You know, Scaramucci would do these things in Nevada, in Vegas at the SALT conference. And all of a sudden he's just walking around, hanging out, trying to have nobody recognize him. And he was just hanging out with us because nobody made a big deal of him. And he was a cool guy. And then O'Leary, he's been on the show a lot. So he's a great guest. He's surprisingly nicer in person than he portrays on TV. Yeah, on TV, you'd think he was a really mean you-know-what. But he actually can come across pretty congenial when he's one-on-one with you. Yeah, exactly. So that'll be fun. I'll go to Dallas. So yeah, head over to Market Rebellion, folks, and we'll give you the book as a giveaway. If you call my office at 888-988-JOSH, we'll give you the book, Follow the Smart Money, or you can buy that book wherever books are sold, Follow the Smart Money, by John. Is it by John and your brother as well? Yep, John and Pete Najarian. So, folks, give us a call now, 888-988-JOSH for the free book giveaway. When you schedule and keep your no obligation 45-minute second opinion on your wealth, we'll give you a bear market survival guide as well. 888-988-JOSH, 888-988-5674. We'll be back next with John's thoughts on the current week in the markets. Was this a bear market rally, or was last week the bottom? When we return, this is Josh Jelinski, the financial quarterback. Don't touch that dial. And we're back. This is Josh Jelinski, the financial quarterback, with John Najarian of marketrebellion.com. Also, you can get the book, Follow the Smart Money, if you call us at 888-988-JOSH. So, John, markets had an impressive rally this week, up like 5-6% as we near the close. It looks a bit to me like a bear market rally, but we'll see. What do you think? I do think it's that until or unless the following, Josh. So we've got a lot of indications that the Fed is already overreaching with these interest rate hikes. They waited too long. I'll bet both of us thought that the transitory term that the Fed used was not correct, that it's been out there for 18 months, but they wanted to say inflation, yeah, it's up, but it's transitory. It's going to come right back down. It's going to be sticky. Now they can solve that. And as you know, they have that dual mandate. On the one hand, they have full employment, or as full as they can help create. And on the other hand, they've got price stability, which means inflation, really. Because if inflation's going up a lot, you don't have stability. So that's their dual mandate. They are the only Fed in the world with two mandates. Like the European Central Bank does not have that. So I worry, Josh, and I have worried since they were so late in increasing the rates, that the Fed would overreach, would push us to 4% on the 10-year, and that would impact consumers with their credit cards, with their mortgages. Mortgages have already doubled this year. Just in the last 2 months, they've gone from under 3 to almost 6% on the 30-year. So that's that issue that the Fed can hit inflation, but because they're late, if they hit it hard, they will hit employment as well. So there was somebody from Rabobank that made a good statement today that I was following, and that was that the reason the markets have rallied this week, 5%, like you say, is because more and more people believe that the Fed, by September, they're done.
The Fed wants to talk tough and say, we're going to keep hitting this thing as hard as we need to. No, they're not, because then they'll crush the employment side versus the inflation side. They're going to pause, I think, in September. Now, do they still give us a 75 basis point increase in July? They could. I think that's a mistake, but they could. I think they might drop that down after they've seen the damage in the market. But here's the evidence, Josh. The evidence is that last Thursday, we got to 3.48 interest on the 10-year bond, US 10-year bond. Today, Friday, we got to 3.04. So that's 13% drop in a week. The reason we have that, I believe, is that more people are in the camp that I'm in that says the Fed is not going to just go, pedal to the metal and give us interest rate hikes that are going to drive us into a recession. They're going to try to avoid that as best they can. I hope, I think it's a really small runway that they've got to do that, but I'm hoping they can do that. And if they ease off the brakes in September, I think we'll be okay.
I think they have to. I mean, what's the alternative? A depression? I mean, we could see the S&P down to 3,000, even with a 75 basis point hike in July, and just the fear. I've not seen this level of fear since '08. Just people are freaking out because they made so much money the last 10 to 12 years. They're almost like, hey, I'm going to cash out and buy an annuity or buy 10-year treasuries. I mean, I talk to people all day and they're just like, get me out. And I'm, but it's, I think when the S&P fell below 4150, what was it, in April? That to me was the floor. This market showed enormous resiliency. January, February, March, 4150, it rallied. 4150, it rallied. Then once we broke 4150, which I believe was tied directly to the 10-year rising, similar to what happened last week, that things, all bets are off. I don't know what the bottom is. People say, well, where's the bottom? I don't know. It could be 3450, it could be 3000, it could be 3500. I just don't think the Fed is going to intentionally tank the economy. I
agree.
I think Powell wanted to show strength. He wanted to show resolve. It's almost like the Wizard of Oz. He wants to show he's strong so that we don't, Toto him. But I think they know. I think their messaging of transitory was wrong. And obviously you said that, but I want your take on my thought with this. I think they knew, for whatever reason, we had inflation, it ran hot. They must have had some messenger who said, messaging like a corporate messaging person, say stick with transitory because you can't freak people out. But I think they just should have said, COVID happened. We're going to have inflation for a long time, longer than we realize. But it's not true inflation. It's really supply chain related. Because as you see oil's coming down all of a sudden, that to me is bullish. What do you think about oil?
Yeah, I don't think it'll be down for long.
Okay.
But it's a welcome relief for sure. I don't know that, you and I know a lot of people that trade commodities like crude oil, and they do have bull and bust cycles all the time. Crude oil, natural gas, these are two very volatile commodities. And I think because of Russian aggression in Ukraine and the sanctions, because that's our reaction. Food prices are up because of Russia and Ukraine. Fuel prices were already going higher, but they're higher because of sanctions now, not because of Russia, Ukraine, but because of sanctions that we've put on them. I'm not saying that's wrong, Josh, that we can't just sit back and see people slaughtered and not give Ukraine some support. But let's be clear, food, because wheat comes out of Russia and Ukraine, corn, and all kinds of fertilizer comes out of there. So that's the food side of the equation. The natural gas and crude oil that come out of Russia, that has been European sanctions that have driven those prices through the roof. Now, that's going to happen no matter what now. Because of these sanctions, it's only going to get worse. And China, always the wild card, right? China has been shut down. And that's another reason that
so you're bullish on oil long term. You think it may go down. You're not of the
I think
camp.
China's going to buy all they can get when their economy reopens.
Okay.
I think it's a mistake to have zero tolerance for COVID, but they don't ask me. But I think the opportunity here is to buy on this dip, because I think energy is going to be dear and higher priced in the next 6 months.
Great. Well, I'm going to get your take on a chart. You want to do some charting and some TA?
Sure.
So that'll be fun. I had a chart. We have a chief market strategist, Stan Harley, who's a big chartist. And I want your take on this latest chart, because it looks on XLE and some other things. We'll talk more about oil. We'll talk about some opportunities to seize and risks to avoid. The John Najarian of CNBC sees right now also Market Rebellion. And I'll give you his book for free when you call us at 888-988-JOSH and schedule your 45-minute bear market survival guide, or you can get it free on Market Rebellion. Go to marketrebellion.com as well. So folks, we'll be back after these messages. And we're back. This is Josh Jelinski, the financial quarterback. Going to get some charting. Can we show my screen, guys? I'm not the most technically astute guy, John. So I have a whole team. So where's my chart? Okay. I guess the chart has replaced John's face. So go to the, can you see my chart? John, can you see my chart or no?
Absolutely. It's the XLE.
So this is really high, overbought. You're still bullish on this?
I am. And I am because we're not really producing that much more today than we were a couple years ago. Demand is going to be high, and it is already higher because of those sanctions I mentioned. I mean, Europe is the second largest economy if we look at it as one economy. The Eurozone is the second largest. If you have China coming back into the game as they reopen, then I think, it's Katie bar the door. I think we're going to be looking 120 to 140 for crude oil.
Wow.
And we've already, broken 120 and pushed towards 130 in the Brent contract, which is, of course, the one for the European area. Wait till a colder winter starts coming, and they're already talking in Germany and a bunch of the countries that depend on Russia for natural gas. They're already talking about having to go back to coal because many of those countries had shut down their nukes. And, what are you going to do for energy then? Nat gas is almost instant on power. We all know that. Coal is a very good source, but it's dirty, puts a lot of stuff up the stack. And if you wanted to have a cleaner earth, you don't want more coal being burned, but you're going to see a lot more coal being burned over the next 2 years. I think those stocks are a steal on any dips. I think Patterson Energy, PTEN, and some of those are going to be great performers. It's not just crude oil or natural gas. I think you want to watch coal too, because that's one. Obviously, there's a difference between metallurgical coal and the coal you use for power plants. But I think this is going to be an area that we're going to see increased demand like crazy. By the way, we've already seen it in Camco CCJ, which is, uranium.
Uranium, yeah. I've been burned on that one before, but yeah.
Yeah. Which sounds like I'm stuttering, but that's another symbol that's a big uranium play. They're going to be fighting for uranium.
Oh, yeah.
I don't think they're going to fight wars over it, but they're going to fight for it because you need to keep those existing nuclear plants fed, and that's what you put in them, uranium. That's
we're
the
not
driver.
making any buy or sell recommendations over the airways, but this is great. I love getting, sometimes you get people on the show and they never tell you anything. They give you no investing themes, so it's cool to hear it. So basically, you like uranium, you like coal, do you like natural gas?
Yes.
And you like
I
crude
do.
oil?
On this pullback in particular, Josh, because, just basically 10 days ago or less, it was 960. It traded below $6.20 per million British thermal unit or BTU just today. So you're getting a deal. And yet Russia, I've tweeted it. I bet your listeners and viewers could either Google it or already know this, but Russia, through their Nord Stream 1 pipeline, has been cutting back on natural gas shipments already to Eurozone. That's why they're panicking. So Europe will be willing to buy any natural gas that we'll sell. Obviously, we do not have a pipeline overseas, so that's got to be LNG or liquefied natural gas. And a player worth looking at there is GLNG, like global natural gas, GLNG.
Interesting.
That's, I think, one you want to watch going into the winter.
Do you like lumber and copper? That's really come down, or no?
I'm okay with both, but I don't see the demand build there.
Okay.
I think the demand build for energy is going to be staggering because, again, China reopens. Okay, so presently they're probably consuming 1/5, 20%, let's call it, of what they normally would. If they come back to fully online, those factories, the workers traveling to and from those factories, whether they're doing it in gasoline-powered vehicles, hydrogen-powered vehicles, or if they have to, the natural gas as well as coal that makes electricity for China to charge the EVs that they've got, because they've got a lot of really cheap EVs over in China. They're not Teslas. They're $15,000 and $25,000 vehicles that are probably
they're like souped up golf carts, right?
Yes, that's exactly right.
And
so they're cheaper, but they don't burn fossil fuel. But you somehow have to get electricity into them. So, like I say, I think demand picks up dramatically this winter.
Yeah, this is where I call environmental nut jobs are a mental disorder on the entire society. But with John Najarian, you're saying it's a great investing opportunity. I just think the environmentalism, and I'm all for conserving the environment, not littering, being good stewards of the environment, but all of these governmental policies by the US, by the EU, you would think they would have had like a Marshall Plan for nuclear or something, because if we go all electric, I have a Tesla, I'm all for the environment, all that stuff. But I look at my electricity bills and they're like quadruple what they used to be. Where's that electricity coming from to fuel my Tesla? It's coming from nuclear. It's coming from coal. It's coming from gas. People don't get that. I don't know. It's one of these things where the laws of economics can't be repealed. So how do you, I don't know. I just think we as a country, whether left or right, if we're going to go with this Green New Deal or everybody driving EVs, we have to understand that we're going to need energy to fuel the batteries, but people just don't get it. So how do you I guess it's an investing opportunity.
It is. And there's a couple, there's one stock that's sort of been under the radar for a while, and it's ChargePoint, CHPT. Full disclosure, I own it. But what do? Just like Blink, they are a charging station operator. They get paid to basically charge up your Tesla, charge up your Lucid Motors, charge up your Volkswagen ID4 or whatever it is. Those fast charging stations are all mainly those two. ChargePoint, which is up from the single digits just 4 months ago to today, I think it might have pushed to 16. And that's against a horrible market. Until this week, as you know, we had just been plumbing lower and lower and lower. And yet this company has been moving from the lower left to the upper right, with some corrections for sure. But, that's one of them that you stand to benefit from if you're willing to take that shot that we're going to see more EVs in the future, like the one Josh drives.
Yeah, I don't see the EV demand lessening because you have the government's paying you to buy an EV. They're paying you to buy solar. That's about the only thing good, I guess, that's happening of this. But you're on CNBC all the time. Do you talk to policymakers? Are they planning? I thought with the Green New Deal we would have some type of nuclear
sadly,
thing.
If I don't counsel the president except through my Twitter account. But if I did, I would have said, do Build Back Better first before you do the other two ludicrous, spending programs. Because Build Back Better in it had a whole bunch of things for repairing roads, doing new airports, doing, repairing mass transit, doing things that are important. Instead, we gave people another round of stimulus checks that they didn't need. A lot of them, a lot of the inflation we're seeing is because of that, I believe. And if we had, he wanted to have 500,000 supercharging stations across the country. If you had that, can you imagine what the EV adoption would be? But that never passed. And it died on the vine. And luckily it did, like I say, because they had two more big, huge $1.2 trillion, $1.9 trillion bills before they were going to do the $5 trillion Build Back Better. If they would have reversed the order, they never would have done those additional payments to people that they were making stay at home, which would have been bad for them. But inflationary pressures would not have been nearly the same. And yet we'd have charging stations, we'd have better airports and roads and mass transit. But,
And you could have had jobs because of the people being hired to work those things. I still think I'm all for EVs, but we got to repair the infrastructure. I don't know if you see this in Puerto Rico, but in Jersey, everybody's driving Teslas. We've had more brownouts in New Jersey in the last year than I could remember, and I'm sure it's because of all the Teslas just zapping the energy out of the grid. But I'm not an expert on that. So we'll take our short break. Get your thoughts on that, and we got live studio audience questions from Clubhouse. So, folks, if you're on YouTube, type in the chat box your question for John Najarian of CNBC. Also, you can learn more about his work at Market Rebellion. Let's go to Dallas. You can learn about that convention. I guess that's on the Market Rebellion. What's that called, the Dallas thing?
If they go to marketrebellion.com/Dallas, they'll see all about the big Rebel Con, we're calling it, September 21st through 24th in Dallas, Texas at the Four Seasons.
That'll be a lot of fun. So, yeah, that'd be cool.
Yes, sir.
So, folks, give us a call, 888-988-JOSH, if you like what you're hearing. Call us for the 45-minute bear market survival guide, and I'll give you John's book for free. It's called Follow the Smart Money. Up next, we'll talk more about opportunities to seize and risk to avoid in this uncertain market. This is Josh Jelinski, the financial quarterback. Don't touch that dial. And we're back. This is Josh Jelinski, the financial quarterback. We're with John Najarian. So, John, are you fundamentally, there's a lot of camps, bulls, bears. Where do you think the bottom is on this market? I mean, nobody can perfectly call anything, but.
We thought that we could see 3,400 or 340, which we got plenty close to that. So I don't blame anybody if they're buying here. Do I think we've been at the bottom yet? No, I don't. I think we could still hit it one more time and maybe hit 340 or something like that, 3,400 in the S&P. And, smart people like Mike Wilson are saying we could even go through that and hit 3,000 or 300 in the SPY. I don't really think that we're going to do that unless Jay Powell does drive us into a recession. And I think he's going to be loath to push us that far to try to, get his arms around inflation. But, obviously the Fed is embarrassed right now that they went as far as they did, saying it was transitory. Yellen has apologized. She's the former Fed chair. Now she's the Treasury person. Jay Powell and most members of the Fed have said, yeah, we waited way too long. We're sorry. The last thing they want to do is do it again and say, okay, but now we got inflation corralled and we drove the US into a recession, which means negative GDP for 2 quarters. That'll cost jobs and that'll be painful. They don't want to do that, especially doing it into an election. So that's why I think they pause in September, because November could be a bloodbath anyway. And if they continue to press and rates go higher, and that 30-year mortgage goes to 7% instead of 6% and so forth, then, people are just going to throw up their hands. And I don't know if the Democrats get a single vote if that happens, because, people will be panicking. They'll want change so bad. So I think you're going to need the Fed to be really careful and thoughtful about September. And I think they will be.
So we get some questions from the audience here. John says, what happens when the markets resolve itself? Commodities are going to plunge. Do you think that or no? I guess not.
Well, when the person says markets resolve themselves, I'll say, you mean not the markets, but you mean demand for crude oil and food sources, because that's, those are 2 of the big things that we're talking about. Russia and Ukraine supplied almost 30% of the world's corn and wheat up until the war started. Now a lot of it's rotting in docks in Ukraine. Some of it's been stolen by Russia and sold to other countries that aren't friendly to the US and so forth. So that's not going away. And the sanctions are not going to go away. Even if Vladimir Putin was taken out, whether that means removed or killed, until we know who the next guy is, we're not taking off those sanctions, nor is Europe taking off those sanctions, because they're scared to death of Russia and what Russia would do next, because they've used a bunch of old technology with the exception of a couple hypersonic missiles. We don't want them going after another country in Europe. So those sanctions are going to remain in place, I think, for at least a couple years. So as far as resolving the markets, it's really, we've got a supply-demand issue. We've got more demand than supply. And that kicks in bigger when China comes online.
Yeah, and it's not like we're drilling, right? Or it's not like we're doing nothing to help the supply issue. So I think you're right there. So you're fairly, you think maybe there's another leg down in this. Are you with the camp that, you don't seem to be in the camp that says S&P will hit 3,000, though? You seem...
No, I am in the camp that says, I think, 3,400 or, again, 340 if we're measuring it in spider terms or SPY. I think that's a possibility. If we get worried, we've got another Fed meeting in July. We've got Jackson Hole when, the Kansas City Fed hosts that big event. And if Jay Powell says something, or Mester or any of the other Fed speakers say something that sounds like we're not stopping at all in September, then I think, recession would be a much bigger possibility than it is today. I hope that doesn't happen, but if it does, then we'll go to 3,400. If it doesn't, then we've seen the lows for this market in the, I don't think we go revisit the lows if we don't push towards that recession.
Yeah, I think if they head hawkish, we'll go to I might be like the Michael Smith camp. I could see 3,000. But I think Jerome Powell is actually doing a nice tightrope. I think if you read what he's telegraphing, it seems very thoughtful. He seems to understand the issue. I think they're going to do the 75 basis points in July because they sort of have to. But things will cool. Housing markets will slip. That year-over-year inflation number will start going to 6 or 5, and then that'll be the signal they need to say, hey, it's cooling. I think. We'll see.
Yeah.
And that would be more bullish. But we'll see. You know, the one thing that you brought up to me that I didn't think about that could be bearish is if oil, for some reason, I don't know, until I've been talking to you, I was thinking, I could see oil go down to 90 again. Maybe short term, but you're getting me to think of that, which to me could be bearish because then that inflation number comes in higher than expected, and then see, the Fed does not want to lose the illusion of control. And if they start losing the control or the illusion that they're powerful, then watch out. You know, then they start doing dumb things that crash the markets. You know, it's really a shame that our market's so weak that it's relying on that. So, okay, we'll take our final break of the hour with John Najarian. We'll go to more questions from our live audience on Clubhouse as well as YouTube. So give us a call, 888-988-JOSH. Go to marketrebellion.com. Go to that RebelCon conference in Dallas, marketrebellion.com/Dallas. And, you know, I'm game. I haven't gone to an investment conference in a while since COVID. I should go. You know, we're all locked in our little cloisters, and so that'll be fun. So marketrebellion.com. Also get the book, Follow the Smart Money. Either go to his website, get it, or call us at 888-988-JOSH and request your 45-minute bear market survival guide, 888-988-JOSH. We'll be back after these messages. And we're back. This is Josh Jelinski, the financial quarterback. We got a bunch of questions. Next, we're going to go to Sloan, who has a question for John Najarian. Go ahead, Sloan.
Good morning. I appreciate you bringing me up. Thank you. Just a quick question, because this is all very new to me and I'm learning it. I'm trying to understand it. But is all of this a part of the economy recovering from the pandemic fallout, or is this some other? I just want to understand the origins, I suppose. Thank you.
Mm-hmm. Sure, Sloan. I think it's a great question. So thank you for that. I think the pandemic didn't allow people to spend the way that they normally would freely spend. They certainly had to, continue to eat, and in many cases travel. I traveled a lot during the pandemic for business primarily, but a little bit for pleasure. A lot of people didn't get to do that at all. A lot of people were pretty much locked down, just like Josh said, cloistered, I think was the term he used. And I think a lot of that money is being spent now. Some of it's being spent on experiences like travel. Some of it's being spent on material goods. And obviously we're seeing that in inflation. And I think the fact that the Fed gave away or had to print so much money, trillions and trillions of dollars, is why we haven't. There are other contributing factors. Certainly the China and supply chain issues, that we can't get enough of certain supplies right now. So that means, again, whenever there's a situation where you have more demand than you have supply, you're going to see prices up. If you have oversupply and flat demand, you're going to see prices down. Those two factors are why we see prices go up and prices go down. And I think right now we're still in that mode of pushing to the upside with prices, because there's more demand than supply, and because China and other parts of the world that are unlocking are going to push up prices, because they'll compete for the goods that we want, whether it's crude oil, natural gas, or computer chips.
Oh, great.
Thank you. That absolutely makes sense to me. I appreciate that.
Thanks, Sloan.
Thanks, John. Thanks, Sloan. Next question. So we talked about some opportunities with EV, gas, oil, coal. What about retail? I mean, you got some great stocks down like 25%. Do you think retail is screwed like the CEO of Target says about every week? He says they're doomed. I don't know if it's one of these things he's trying to temper like expectations so that they can surprise to the upside. But you got Costco, Walmart, Target, all battered a lot. We own that for people. Those are great long-term plays. Apple's down significantly, although that's another kind of angle. But what's your thoughts on retail right now?
I think you'll see a lot more consolidation in retail. And I think overall, retail will come out of it okay, because I think they will right size a lot of their inventory. That's what Target's doing right now. That's what Brian Cornell, the CEO at Target, that's what he said he was doing. Americans will go flooding into Target stores right now because they know he's going to have markdowns to move that inventory. He's going to be running ads on Instagram, on TikTok, on whatever, to get people into the stores. Same thing over at Walmart, same thing at Macy's. They will right size their inventories. And as you and I know, they're going into a season where a month from now we'll be talking about, well, how's back to school shopping going? Because, we'll be at the end of July instead of the end of June, and people will be getting ready to make that spend into that. And I think that before that, they want to clear these shelves and get as much of the old inventory out. So I think that really benefits TJ Maxx, symbol TJX, and Kohl's, because KSS, because those two are big on basically discount selling what other people need to push out the door. So obviously Brian Cornell can cut prices at Target. He's not going to push stuff over to TJ Maxx, but some of his suppliers for the things that he buys are going to say, wow, we've got too much inventory now. Let's get rid of this because we need to pay the bills, and we got to get, we have to be ready for the next season of whatever it is, swimwear goes away.
Yeah, you're really good. I love you. You're awesome. I just got a text. I'm looking at buying, lawn furniture, patio furniture for my wife. You know how expensive that stuff has gotten?
Oh yeah.
I went to Costco. Okay, you think you get a deal. $3,000 for a set from Costco. I don't know if they're tacking on additions because people bring their 10-year-old. At my Costco, people bring their 10-year-old set and they want their money back, and Costco will do it. But I got a 50% off site-wide sale from like a high-end, from Frontgate. So you're talking high-end. So Frontgate is now the same cost as Costco, which Frontgate's like the restoration hardware of outdoor furniture. So,
I agree.
So that tells you, that does worry me though a little bit on the stock market. If they're slashing 50% now, wonder if they're seeing some dried up demand. Well, I guess that would be bullish long term, because then that means inflation is starting to cool a little bit. I don't know. What say you? 50% off?
I would agree.
2 weeks?
I think it does tell you that inflation's cooling off a little bit. Have we hit the peak yet? Can't tell you that, because I don't know what's going to happen in Ukraine, and I'm only guessing that the sanctions stay in place for a long time. So it might cool for a little bit, and then I'm not saying a V-shaped rally right back up, but the XLE was 92 just a little bit ago, like less than 3 weeks ago, and it traded down to 70 or even lower. That's a really big drop for a broad market ETF on energy.
Yeah.
So, because it's not just one or two, this is like a 14, 15 stock ETF. I would say we're going to see energy prices moving back up as we go into winter. So I think overall, I would be a buyer of weak energy stocks on the dip.
And we're going to go next to Jennifer as a question on EV competition. Go ahead, Jennifer.
Thanks so much. Hi, John. Thanks so much for coming today. I have a question about some of the competition in the EV space. Specifically, I'm thinking about Fisker and the new Fisker Ocean, which is not going to be out until the end of 2023, but it seems to be something that people are starting to talk about. Do you have any insight or opinion on the Fisker or other EV models?
Great question. Thanks, Jennifer. Elon Musk has a significant edge, several significant edges in his production. I'm going to answer this part of the question first, which is the competition for Tesla. So Tesla has more data on autonomous driving, more data on batteries, how well do they perform under all conditions. Tesla has more of that than anybody. General Motors, Ford, Mercedes-Benz, Fisker, Volkswagen, they're all going to be competition, obviously. But they're also, I have watched, Jennifer, the prices of those other vehicles going up very dramatically. So for instance, I put my name in for the electric Hummer because you only had to put $100 down or whatever it was. Same thing with the Ford Lightning. I put $100 down. I'll either sell my spot in line or I'll take a delivery depending on when they do it. But the price of that, Jennifer, and I'll get to Fisker in a sec, but the price of that Ford F-150 Lightning is now over $100,000. Now, all these manufacturers, except for Fisker and Lucid, were going to compete with Tesla on price. They were saying, well, a Tesla Model 3, yeah, it might have a sticker of 35, but by the time you get it out the door, it's 50. And we can make one for 35. No, you can't. No, they can't. They will not, unless Chinese, like Josh and I have talked about the golf carts. Unless it's a Chinese golf cart, you're not getting one out there for 35. It's going to be a piece of crap that nobody wants versus a Tesla that everybody wants. Now, Ford, General Motors, Mercedes-Benz, Volkswagen, Audi, all of those are lithium-ion battery companies. They've all ramped up the price 20, 30% since they have announced that, oh, we've got the EV Hummer, we've got the Audi e-tron or whatever. All of those prices are through the roof. So they're not beating Tesla on price. And people will be somewhat suspicious that those are new technologies in a very tough market to compete in. Yes, they can make a car better and longer than Tesla's made cars, but do they know that much about EVs as Tesla does? And the answer is no. But as far as Fisker and Lucid, because I think they're the closest to the high-end Tesla, whether it's the Plaid or any of the high-end Tesla products that are six-figure cars, the Lucid and the Fisker will both be six-figure cars. These are not cheap vehicles either. They're beautiful, and I love them. The question is, they have to compete for those same lithium-ion parts that Elon Musk does, but he makes 500,000 of these vehicles. These guys are going to be just like today. It was NIO over in China was talking about they took 30,000 orders. That's a big difference, even for a really cheap EV in China, the NIO, N-I-O, or Li, L-I. Both of them are competing for those same customers and trying to hit a low price point. Lucid and Fisker are not trying to hit a low price point. So, it'd be like comparing, a Nova to a Porsche or something like that. If you're a Nova buyer, you're going to buy the Nova. If you're a Porsche buyer, you're not going to downgrade to the Nova. So you have picked the high-end Fisker, which is high-end and beautiful cars. Same thing with Lucid, I think. So I like both, but I still think the better investment is Tesla.
Thank you.
That's fun.
Thank you, Jennifer.
And as we conclude this segment, this was a lot of fun for this interview, John. What other opportunities do you like in this market or things to avoid? sectors?
I think cryptocurrencies are something that if anybody looks at those, first of all, Josh should say they should have their head examined probably, but really just focus on the big two, on Bitcoin and Ethereum. I think you'll be better served doing that. As far as stock market, I think overall the consumer will do just fine after they get used to these higher prices. And the ones that I worry about most are people that overextended for a home and did it with a non-fixed rate mortgage because they're feeling the most pain. It's not going to be the same as 2008, in my opinion, Josh, because we're not letting people do those ninja loans where they had no money and they levered up like crazy. But nonetheless, if you put 20% down, you had to buy private mortgage insurance or PMI, and you have your costs doubling, you might not be able to afford that home. So I think that's where you're going to find some opportunities in the market, sadly, as it always happens. You know, it's feast or famine for some people. And for people that are over levered in those mortgages and things, there will be opportunities for people out there to pick up homes for a lot less than they thought when they look at today's prices that are up 40% from 2019 prices. I think housing prices settle back down to earth a little bit.
No, I agree there. I actually think they may go down further. I know we've had Barry Habib and other people who've given a great narrative on how they don't really think it's going to be like '08. But I try to talk to people not in our industry, you know, just to see how they're doing.
Yeah.
I'm not everyone, but 90% of the people that I talk to are struggling to just pay their grocery bills and gas. I don't see, you know, I don't think it may take 12 to 18 months to have that real estate correction, but I could definitely see a drop in prices because I just don't see.
I could too.
The
And that's not
affordability.
good for Lennar. It's not good for Pulte. It's not good for Toll Brothers. But I think on significant corrections there, and they'll be about 6 months ahead of those softening markets, I think then you step in.
So you don't like the home builders now because they've just been
not right
cut
now,
in half.
not with higher rates, even though they have no supply, which is another problem for them because you can't sell what you don't have.
Yeah.
But they might get back some of these homes through some of those, like I say, over-levered players.
No, fantastic. So John Najarian, marketrebellion.com. Folks, go to marketrebellion.com. Thank you so much. It was a lot of fun. Bears linebacker. You remind me of my dad's story. His claim to fame, although you're a way better football player to make the NFL. That's amazing. My dad's claim to fame was he was a tackling dummy for the University of Oklahoma, national championship teams. So he was like the third string, but he was excited he made the team. You know, it's like a walk.
Oh, hell yeah. He should be proud. I'm sure you're proud of him.
And
that's an accomplishment.
But
that was back in Bud Wilkinson days.
Yeah, I think it was in the 70s, early 70s, late 60s. And it was fun, you know. But yeah, he would have, like, if he didn't play then, he probably could have played for some other lesser team, but he really wanted to go to University of Oklahoma. And then he met my mom, and then he dropped out of college. So you never know what would happen. But you know, if he stuck with it, you know, he made it as a freshman. That was quite an accomplishment. He wasn't recruited. And you know, he'd be like, you know, Billy's, I don't know who, you know, he had the famous running back. He said, oh yeah, he gave me a black eye and gave me a stiff arm. And so that was a lot of fun. So John Najarian, marketrebellion.com. Go to marketrebellion.com/Dallas. Go to the Rebel Conference. I want to be there. And also get the book, Follow the Smart Money. You can buy it on Amazon, wherever books are sold, or go to Market Rebellion. They have a free offer on it. Or you call me, 888-988-JOSH, and I'll buy it for you for free. If you schedule and keep your 45-minute bear market survival guide. And John, oh yeah, surprisingly, I don't like Ethereum at all, but I do like Bitcoin.
Yeah.
But I think it could go down to 15,000 or 8 to 10. I think we haven't seen the pain yet because of so much leverage. I don't know what you think. I'll ask final thought on that.
Gosh, I hope we've seen the pain, but they always talk about network effect, which is the number of users, the number of people that have accounts, versus the value of Bitcoin and Ethereum and so forth. That has continued to rise. The network effect has continued to go up. There's a lot of people that have suffered some pretty good pain. I would say that in past corrections, we've always gone down to the previous bull market high. And so the last bull market high was in 2017 and it was 19.9. We got there last week. So we rebounded somewhat from that. We traded all the way down into the 18,000 range. And I think as long as we don't just have this drumbeat of bad news for Celsius or for UST or whatever, Luna, I think that the worst might be over for Bitcoin and Ethereum. I wouldn't touch the other coins right now.
Yeah, avoid them. No, I agree with you. So thanks so much, John Najarian. It was a lot of fun.
My pleasure, Josh. Thank you, sir.
Take care. Okay, so Clubhouse and YouTube, we're going to be taking your questions on all matters financial. And thank you, John. You can feel free to go. This was a lot of fun. We'll have you back on again.
Thank you, big dog.
Awesome.
Really
This was
enjoyed it.
great. It was fun. We'll have you on soon. So
Thank you.
yeah, it was great. Yeah, he was a lot of fun. So folks, ping